Good afternoon, everyone. My name is John Cavallone. I'm the partner in charge of the Citrin Cooperman broker-dealer practice. Today, we will be presenting to our attendees some very relevant information as you begin getting ready for your upcoming audit season. Probably right now you're starting. Joining us today, we have Oren Bosson, a CPA partner at Citrin Cooperman, who also works primarily in our broker-dealer practice. We have Laura Crowley, CPA MBA, who is a director in our New Jersey office and works on many broker-dealer clients with Oren, myself, and our New Jersey audit partners. We also have Jay Gettenberg, CPA, Managing Director of Accounting Compliance International, one of a few FINOP, outsourced FINOP organizations that we have assembled here today to address our questions from the audience. Also joining is newly promoted Adam Nava, who was promoted November 1st. He's a QC in our QC department at Citrin Cooperman, and he's a former PCAOB broker-dealer inspection team. So he's happy that we're not live because I'm sure some of us would like to throw tomatoes at him or something. Next, we have Janice Parisi, and Janice, I would like to thank you once again. Janice is a last-minute replacement. Janice is a partner at SD Daniels and Company. One of her colleagues was originally scheduled to be present, but he had an unfortunate incident, and Janice agreed to step in at the 11th hour. And last, but certainly not least, we have Michael Stupay, who is a senior managing director at IMS. So collectively, between myself and the panel, we have over 100 years of broker-dealer experience that is here assembled to take you through the topics that we would like to inform you about. So now I'd like to start with our first question, and this one is really directed towards our FinOps. So Janice, what is your advice to clients regarding updating their membership agreements to match their business activities as a result of the recent FAQs put out by FINRA and the SEC? Specifically, as I'm sure most of the folks in attendance know, FINRA for years had defaulted to a K2I exemption. So just curious, what is your advice to your clients with regard to amending agreements?
Okay, great. So yes, thank you for mentioning that I'm in the 11th hour. That I jumped in at the 11th hour. But I definitely have seen a lot of this, and I just want to step back a tiny bit. You mentioned the recent FAQs, and that's absolutely true. July 1st, there was an FAQ that came out from the SEC. So I feel like that sort of brought this whole topic back up to the top and, you know, into everyone's attention. But in reality, and let's just go quickly, back to 2013 when there were certain amendments to Rule 17A5. And those amendments, that's how the requirement for the annual compliance and exemption reports was born. So I believe, in my humble opinion, that once that happens back in 2013 and all of a sudden we have this exemption report, I feel that sort of opens or heightened the question between auditors and their broker-dealer clients, like, hey, by the way, we're going to be auditing that exemption report. What exemption do you claim, and does that align with your activities? I feel like it just sort of heightened that question. As you mentioned, countless firms were assigned or have a FINRA membership agreement that indicates K2I exemption from Rule 15C33. And I don't know that that was always accurate and sort of used as a catch-all, as you mentioned, John. So I think now the whole industry has sort of woken up to this issue. And back in 2013, that amendment that I was talking about, there was some language in there, and we now call it footnote 74. And basically that language was explaining that there may be certain circumstances where a non-carrying BDA meets certain conditions, not holding customer securities or funds, but they don't really fit into those exemptions, such as the K2I, as so many firms are claiming. So that is what we call now footnote 74. So like you say, there were the FAQs, that was sort of a reminder to everyone. And I think that's opened the conversation between a lot of firms and the auditors. And so FINRA is aware, and some FINRA risk monitoring analysts, in my case with my clients, did reach out and say, hey, this is what's happening. And hey, if you want to amend your membership agreement with us, we're happy to help you with that. I would say less than half, maybe a quarter of my firms had that happen. But if I felt that this was something that may be an option for any of my clients, I brought that subject up with them. And so we have in fact done that. I wouldn't say I advised my clients to do it, but I gave them the information. I explained everything to them, and we coordinated with their auditors and their risk monitoring analysts at FINRA, and we did get it done in all cases where it was appropriate. I feel that it's something, again, that you need to communicate with the auditor as well, between the FINOP, the firm, the auditor, and make sure everyone's on the same page. So yeah, I'm definitely leaning towards amending the FINRA membership agreements.
Okay. Mike, would you have anything additional to add to that?
Yeah, I mean, this is old news, but it really, I guess, codifies in some ways what's been done since 1785 was amended 7 years ago. The one thing I need to caution you about, if you go this route and amend your agreement, you have to look at the other paragraphs in the agreement, because as far as I understand, they're just going to amend the K2I exemption within your membership agreement. Meaning if you have an agreement that states you have 2 reps and 1 office, and you know, these agreements may be as old as 1998, and you had 1 rep, 1 rep, 1 office, and now you got 5 offices and 50 reps, you can't exactly sign a membership agreement if they only change that 1 paragraph. So that's been a bit problematic. And Lisa Robinson from FINRA has basically told us it's your choice to amend. But you know, that's up to the firms. Like I said, it's old news. I would just proceed as is and let it go. But it's really more for the auditors to get comfort as to what's really going on between the member and FINRA.
Good point. Jay, anything you want to add to that?
Yeah, I think the most important thing by far is just making sure that the exemptions that you're choosing both in your audit report and on your focus report actually are directly correlated with the lines of business you were conducting as a broker-dealer. So we've seen firms who, you know, were checking the K2II box because they had a clearing relationship, but they also were receiving, you know, 12B1 fees or some sort of, you know, direct compensation via, you know, check, wire, ACH. So making sure that the audit exemption report and ideally the focus report actually directly reflect not only one line of exemption that you qualify for, but all of the applicable lines.
Good point.
There's one other thing I wanted to add to that. Along the K2II exemption, where you're fully disclosed, many firms had that exemption and then they dropped their clearing firm in lieu of just doing private placement business. So I have a firm where I would not go back and allow them to take out the K2I exemption should I ever want to do fully disclosed business again. Because if I take it out and then I want to do it again, I got to go through a CMA according to FINRA. So it's just a line that I'm permitted to do. I'm just not conducting it at the moment. So be very careful what you ask for.
And Mike, I just have a quick question with regards to that. So are you saying that you believe that FINRA is not going to eventually, because they've put in this new allowance now, you don't think at some point in the future they're going to start asking you to actually, the broker, to be reflective of what's actually happening? You don't think that's going to happen?
Well, the broker is reflective. The audit report states it. Their books and records state it. The focus report state it. You're talking about a membership agreement. Yeah.
If they're
they don't show
but they don't have it.
No, I mean, I don't know about others, but we haven't shown K2I exemption, you know, for 6 years out of the 7 that it's been changed.
Right. So let's jump to our second question and give our auditors an opportunity to chime in on this this very issue. So we'll start with Warren. Are there any additional audit procedures or review procedures required under either scenario, meaning your client amends their agreement or doesn't amend their agreement?
Thanks, John. So kind of like what Jay said, you know, it's all about Jay, Mike, and Janice. They all mentioned the same thing. You just have to be consistent across the board in terms of what the membership agreement says, what the focus report says, and what your operations are. So that's what we're going to be looking for, to see that we're going to ask for the continuing membership application agreement. We're going to look to see that that reflects what's on the focus, and that's what reflects in the operations of the company. So along the lines with that, we'll ask for the new agreement, because you know, if we see a change, we'll ask for it, and along with the exemption report now. So we're going to look for that change in the exemption report that the company is filing. You know, the new option is we have no obligations under the 15C3 rules. So we'll be looking for that. We're just looking to see that everything's consistent. Aside from that, in terms of procedures that we're going to do, the review procedures, they would still be inquiry and analytics, same as we've done before. It would just be, we do expect to see nothing.
Okay.
I guess the one follow-up from the audit perspective is, for firms that were historically filing under K2 single I, who choose or elect not to go back and change their membership agreement, is there any change from an audit perspective in the expectations of what the exemption report is going to say? Are we still going to choose K2I, or are we going to just reference in the exemption report that we are exempt without exemption?
It would really depend on what you have in your membership agreement. If you say K2I, then it's K2I. It really depends on what you choose.
I disagree. I've had, you go back 7 years before people changed their membership agreement. SIFMA even had a template for this particular scenario where you have private placement firms that do not touch customer cash or securities. And they, in the exemption report and in the audit report, it contemplated this back, 7 years ago. So I think it's irrelevant what's in the membership agreement. It's what reality is. Like I said, using the other example where you had a fully disclosed clearing agreement and you were K2II exempt, and you no longer have one. Are you going to say you're K2II exempt without a clearing firm? I think that would be foolish. I think both of them have to reflect reality, not what's in the membership agreement.
Well, in that regards, to reflect what is actuality, you should reflect in the membership agreement what you have. So if you're claiming K2I, your exemption report to say something that's not K2I would be an inconsistency that, it would be questioned as to why you are saying one somewhere and something different somewhere else.
Because we didn't get the membership agreement changed.
Well, I
think John and I have been through this. We've used language without changing the membership agreement going way back.
Right. I think, Mike, to your point, and we have a question that I'll put out there too from the audience, but I think to your point, Mike, is, the exemption report, why would you say something in the exemption report, for instance, that you have a K2I account when you don't? So the exemption report really should describe how you're exempt. The regulators put out this guidance saying, hey, we recognize this now. I think over the years, I've seen more and more clients start to adapt that language, where it describes their business and basically says, hey, we don't touch customer funds. So therefore, we're not subject to 15C3-3. We did get a question from someone in the audience asking if there was any standard language that's out there. I am not aware of anything standard that was put out, but I don't know, Adam.
Yeah, John. So, with respect to the July 1st updates to the FAQs that the SEC put out, the answer 8. So for this scenario where you're not claiming K2I, K2II, or K1, but you still don't have, custodial activities on the compliance report. They now specifically state that you should describe the firm's business activities within the exemption report. And also statements that you did not directly or indirectly receive, hold, or otherwise owe funds or securities to customers, did not carry accounts for customers, and did not carry PAB accounts. So they have kind of put that into the FAQ at this point.
But of course, you need to describe your business activities. So everyone's business activities could be slightly different. Okay, the first question on our next topic, we're going to address to the FinOps. I'm going to ask that we kind of move a little quicker on this topic. This is probably something that folks have heard quite a bit. Jay, we'll start with you on this one. We all have clients that have had PPP loans. Care to share any experiences to date that some of your clients might be experiencing, either with forgiveness, things of that nature?
Yeah, sure. So we at about just over 100 broker dealers that we support on an ongoing monthly basis. We had approximately 40%, about 40 broker dealers apply for SBA funding in some capacity. Obviously, very wide diversity of types of broker dealers. But the application process, I would say early on, was a little bit chaotic. You watch the news and it seems like everything is going, smoothly. But I think in reality, on the back end, there was definitely some challenges in actually getting the applications, organized, getting the banks on board, getting the portals operational. But every one of our clients who wanted to apply were able to do so, were successful in receiving their funding. And we've now, I guess, effectively moved into phase 2, which is working with them through the loan forgiveness process. So we basically opted into a 24-week qualifying period just for simplicity. I would say almost every broker dealer applied solely by utilizing the wages over that 24-week period. And effectively, we have now started the process of actually submitting the loan forgiveness applications back to the bank. So we are recording them with the methodology of having the cash in the bank, having the bank loan payable on the balance sheet. Our position is to leave that bank loan payable on the books as a liability until we actually get a formal document from the bank that effectively that liability exists, until a third party actually acknowledges that it is no longer a liability. At that point in time, we will convert it to revenue. And effectively, from a net capital perspective, we have just had a line for the add back to net capital based on the whether or not the firm qualifies or how much they qualify as of that given point in time, and have effectively done it on a case-by-case basis. Obviously, different firms have different needs. A firm with $10 million in net capital may not need that add back for compliance, whereas you may have a small private placement firm with $50,000 in net capital, where it's the difference between compliance and non-compliance. And we've taken a little bit more of a proactive approach to utilize that add back.
Okay. Janice, do you have any thing new to add to that? And I guess I would also ask, if you're treating it as a liability, are your clients accruing 1% interest on that debt?
Yes, yes to both. And I agree with Jay. We are leaving, for all of my clients, we're leaving the liability on the books. And we will leave it on the books until we receive some sort of formal notification that the loan has been forgiven. We are accruing interest. And I've been told that a number of the bank's portals have been opened where the firms can start applying for forgiveness. But as we all know, it's going to take months and months. So it looks like at year ends, most of these loans will still be sitting on the books as a liability. And then, of course, we'll have to talk about disclosures and subsequent event disclosures possibly for when the forgiveness is actually formalized.
Mike, anything new to add there?
The only thing I would suggest is people or broker dealers should evaluate their position on the matter, because there is some similarities between the PPP and grant accounting. They should come to a conclusion and present it to the auditors before year end to make sure everybody's on the same page, because this could be a very significant disclosure item. It affects taxes potentially, subsequent events if this thing gets done after the end of the year. So I think now's the time to get on the same page so you have no issues during the audit period.
It affects going concern too, potentially, which we're going to talk about in a little bit. So
John, just to piggyback on the conversation about the taxability. So we've actually made a point of waiting for a lot of our clients to submit the loan applications purposely to and obviously it's case by case, and every scenario is different, but to make a point of not submitting the applications too early. We were concerned about the loans being forgiven in 2020 and creating taxable income potentially 12 months earlier than necessary. So obviously firm by firm, but
Jay, I don't want to burst anyone's bubble on that particular topic, but the IRS has come out and said that it doesn't matter when you file for forgiveness, if you expect that the money was used to pay expenses that will ultimately be forgiven, then it will be taxable in 2020, unless there's some legislative action that occurs in Washington, which I think is highly unlikely at this point. So basically, it doesn't matter when you file. If you think it's going to be forgiven, it's going to be taxable income in 2020. So even the expenses that were paid with the proceeds would not be deductible. Is basically the IRS's position. So for the auditors, Laura, we'll start with you on this one. Relative to the PPP loans, is there a preferred method for accounting for these loans, i.e. debt versus equity? We heard, Mike's position, we heard Jay and Janice's position. Would you say that there's a preferred method that we as the auditors would recommend?
Yeah, I mean, I think all, Michael, Janice, and Jay all kind of said they were accounting for it as under the debt method, which is the more conservative way to go, for sure. So I think, as auditors, we like that. It's a little bit easier to handle. But, there is the option to use an international accounting standards, IAS 20, that you can actually recognize forgiveness systematically over the period when you are recognizing the related expenses. The big audit hurdle for using that method is that the likelihood of forgiveness has to be probable, which is a pretty high threshold. We kind of look at probable as maybe 75% or better. And just because these are new loans, a new program, we don't really have the experience, with what is actually going to happen. People, as you're saying, people are just starting to apply for forgiveness now. I don't know of any clients who have actually received forgiveness yet. Hopefully we'll have a little more clarity by the end of the year, or, by the time the audits are going out, as to what those expectations are. But I think at this point, it's a little bit uncertain. I think for smaller loans, it's going to be a lot less scrutiny and a lot easier to get forgiveness than for, the larger loans. But, so conservatively, the auditors probably prefer the debt method as opposed to the IAS 20 model.
It's interesting. So aside from even the debt versus equity model, when we start thinking about the implications for tax liabilities for the entity at the end of the year, and John, to your point about it being income or being taxable irrespective of whether or not it's actually forgiven, how do we assess the probability of something that has no historical reference point from an SBA loan perspective?
Jay, that's a great question, because as we've seen since this program came out, they keep changing rules, right? Mm-hmm. It was 8 weeks, now it's 24. It was 75%, now it's 60. You could deduct rent, now you can't deduct rent to a related party. So they keep changing the rules, and who knows where it's ultimately going to come out. The expectation was right from the very beginning that this was not going to be taxable income. I think that was what the program was intended, mm-hmm. But it never got into the law, like so many other things. The whole reason broker-dealers are subject to PCAOB inspection in the first place is a technicality in, when they wrote Sarbanes-Oxley. So who knows? That's one of the reasons we're advising clients to wait to submit their application for forgiveness. It's not going to change anything. maybe there'll be some clarity on the rules. Adam or Oren, I don't know if there's anything that you guys want to chime in on. Adam?
I don't have much. I think everyone really hit this at this point. That it's if management or the financial statement preparer does elect to go the IAS 20 route, it's an extremely high hurdle to meet that probable threshold. That's the one thing I really want to stress here.
Okay, Adam, you got to speak a little louder, get closer to your computer because you keep going in and out. So.
Sorry.
Yeah, I would just add that if someone went with the IAS 20 method, you'd really have to be careful in making sure you provide some sort of documentation that's going to support that position.
Just a quick follow-up. Do you guys assess your audit procedures for the IAS model differently than the debt model with the add back to net capital? In the context of like, if you have to do an assessment for net capital purposes, whether or not we convert it to revenue versus whether or not we add it back to net capital, the regulatory impact is effectively the same, even if the balance sheet looks different.
Well, the way FINRA is asking you to treat it for add back is essentially keeping it as debt, but allowing the expectation of the forgiveness to be calculated as good capital. So
correct.
I think that would be consistent.
Right. When the expenses are incurred, they can be added back if you're under the aggregate indebtedness method, or add back to the liabilities. Yeah.
So one final question on this that I think Mike will let you start on this. So, are you thinking about your disclosures relative to the PPP loans now? Obviously, there's going to be some requirement there to talk about it. What are you doing for your clients there?
This is quite hypothetical since I don't think I have personally any broker dealers that have PPP loans. But if I were writing financials, I certainly would have disclosures similar to the tax disclosures. Basically that these large loans may be undergoing audit, and the years are effectively open for examination of the loans. That certainly is a material question mark here in terms of whether it gets forgiven or not, whether you have equity or you got debt in the end, and how the company could afford to repay it if that's a consideration. Obviously, the going concern tie-in is important. But yes, there's a whole host of disclosure that I think needs to be considered now.
Janice, anything to add?
Yeah, for sure. And also, as I mentioned, I think that there would be a disclosure about the PPP loan, and I think there may be a separate disclosure as part of the subsequent events to talk about the application for forgiveness. And of course, I think an important thing related to what we've all been saying is to just definitely keep all your calculations, have a calculation for everything. So you can support, what you believe to be forgivable expenses and so on.
Warren, anything to add?
Yeah, whichever method you go with, whatever accounting policy you choose, it's important to make sure that you just disclose what the impact of that is in the financial statements and what that impact is. So if there was a gain because you're doing a grant, you'd have to look at gain contingencies. If it was, you'd have to look at the grant method and disclose that aspect of it if you're going that way. If you're doing it in debt, you'd need all those debt disclosures. So really, depending on what you decide, there'll definitely be some disclosure.
Right. So in the case of debt, you'd have repayment schedules, just like you would on any note, and all the required disclosures with regard to debt. Oren, I'd like to kick something back to you. Is there any chance that you guys are considering emphasis of a matter in your opinions?
It definitely will depend on the facts and circumstances of each broker, but emphasis of matter is a discussion topic. It's something that we'll evaluate on a case-by-case basis.
It's been something that has been in some reports that have gone out on an interim basis, depending on the severity. So will be case by case, but I think the firm's preference, and Adam, you may have a little more insight on that than any of us, other of us, as to what the thought process is. But I know there have been reports that have gone out with emphasis of the matters in there. You might be on mute, Adam.
Oh, I'm sorry. Can you hear me?
Yep.
Okay. Yeah, I would say it's probably more so on a case by case basis, depending on the impact, that would have.
Okay.
John, just to quickly comment. So we actually have a number of, we have about, I think about 30 firms between June 30th and September 30th that have actually already gone through their audit processes, their audit filings. I don't know actually how many of them had SBA, PPP funding or loans on their balance sheet. But the experience that we have had so far is that the disclosures for those handful up until this point in time have been, I'd say, relatively generic. And I don't want to oversimplify the process. But it seems as long as we've included the loan terms, the loan date, the amount, the plans for the broker dealer to apply for forgiveness, a general assessment as to where they are in the forgiveness period, the 24 weeks versus 8 weeks, some sort of general, representation of where the firm stands, what they took, why they took it, and where they stand in the process has been so far sufficient. So obviously case by case, but it hasn't been too terrible so far.
What about emphasis of a matter on some of those reports? Did any go out with emphasis in the auditor's report?
There's been nothing specific from the auditor saying, we have any. There's been so none of those firms, to my knowledge, that have had SBA or PPP funding we've not had conversations about going concern. I actually could theoretically make the argument that the fact that they've actually received the SBA funding and continue to operate would actually, in theory, has strengthened their balance sheet versus weakened it. Right.
Okay. The one thing that Mike, that you mentioned that I think is good, quite frankly, and I hadn't really thought about it, but putting something in the footnote that indicates it's subject to audit. So even if it's forgiven, it may be unforgiven down the road, potentially. So I think that's some good advice. So let's move on to our next topic, and this is going to be a little bit really hypothetical, but it's intended to get people to start thinking about what changes have resulted from COVID. So I'd like to start with our FinOps, and Mike, I'll start with you. What changes to your internal controls at your clients have you seen as a result of COVID and the extended work from home?
I would say most clients had the capability to work from home prior to COVID. So in which case that was sort of built into their internal controls at the time they allowed access from home. So I think the biggest issues are cybersecurity. The actual data is not being changed location-wise. It's wherever it always was. So I see very little in terms of actual client change to operations.
Janice, you want to chime in on that one?
Yeah, I mean, I agree with Mike pretty much for all of my clients, and really as for our practice as a whole, we probably represent about 150 broker dealers, and I haven't heard of one major problem. It's incredible to me and very impressive how everyone transitioned and business has gone on, and business, for the most part is going well. And so I don't know of any major operational difficulties.
Okay. That's not the answers I was hoping for, but Jay?
I think it's a good thing though.
Generally, I would say I agree. I mean, the one comment I would make is I think we've had clients move a little bit away from check processing just because of logistics and more towards some sort of dual authentication on the bank, just for putting up and approving wires. That functionality was there before. I just think some of the firms defaulted to checks just for kind of the historical they've done it in the past, and they continue to do it up until COVID. And I think that kind of just forced their hand a little bit to kind of become a little bit more technologically savvy and do things in a little bit more of a modern way. But I would agree with both Janice and Mike. I don't think that our our clients' general internal controls have materially changed.
Okay. Now I'm gonna take this now to the auditors, and I think you're gonna hear a slightly different opinion here with regard to this. So, Oren, we'll start with you on this one. So, obviously, this extended work from home has potentially created some additional items that we need to consider in our risk assessment procedures as a result. So, can you walk us through some of what you're expecting, or maybe have already started doing on your clients as we begin preparing, doing interim services and getting ready for year-end audits? Sure. Relative to risk assessment and control?
Actually, I agree with the FinOps. I think we're done with this question. No.
Okay. Hey, Adam, we told you.
We all see eye to eye.
I really hope not.
I really think it's a case-by-case basis. So, you know, you're definitely going to have some brokers where a lot of their operations, I believe, you know, they may be easily transferable to a virtual type of environment. But I think the right approach to the risk assessment from the auditor side and even from the client side would be to take a step back and look at what you do on a daily basis. So you think that you're going to get a report at the end of the day, and it's going to look the same as you'd always have it. You review it and you're done. But now you got to take a step back and say, well, how is this report actually getting to me? Is it happening the exact same way as it was before? Or is there something different that's actually happening behind the scenes that you're just taking for granted? So those are the kind of questions we're going to be asking for. We're going to be looking at what actually changed in terms of the control environment, in terms of how something is processed, how something is reviewed. Are there any additional risks now to the way that something is done now versus the way it was done before? So it's just looking at the same things from an additional level, just to see, it might look the same on the surface, but is it getting there the same way? So a perfect example is with checks, right? As Jay was mentioning, in terms of check processing. Well, how does it happen? If something gets mailed into the office, okay, it's going to get sent back. But how is that working now? Is there a skeleton crew at the office? Is the same individual that is the authorized reviewer of this activity or the authorized processor of this activity, are they still the same people doing it? So just a small example of just looking at the same thing, but from a different perspective.
Adam, do you want to share some thoughts?
Yeah, sure. I do agree with what Oren said. I do think that the auditor, obviously under AS 2110, has that responsibility to gain an understanding of the impact of COVID-19, any accounting items affected by COVID-19, lease concessions, impairment, PPC accounting considerations, also analytical procedures that the auditor might do. Maybe you can't really rely on those historical relationships. Maybe those were impacted. Also, was with respect to the exemption report, did the broker-dealer rely on any of the COVID-19 relief in the SEC FAQ that was released? And considerations there on, okay, if they did rely on that, then how are they reporting that? There's really nothing in the FAQ, but the SEC did come out and say, you know what, you have to specifically mention the period in which you're relying on the COVID-19 FAQ guidance. You have to note that in your exemption report. So things like that, that would be my expectation from the auditors as part of the risk assessment process.
Okay, thank you. I do agree with the FinOps assessment that largely the financial service industry, the broker-dealers in particular, have been trending towards this remote work environment for a number of years. I mean, we've been conducting audits largely remotely on our broker-dealer clients for a number of years too. A couple of things that I would like people to keep in mind and to think about. You might have people that are still the same people doing the same function, but they might not be doing that function at the same time. They might not be doing it from 9 to 5. They might be doing it at 7, 8, 9, 10 o'clock at night. There might be even different people doing the function because maybe somebody didn't, want to come back to work or had family members that they needed to care for. So these are some of the things that we need to think about too, in addition to relying on the relief that's been out there and the cybersecurity and things of that nature. And, you know, we need to address it in our risk assessments. So we need our clients to start thinking about, well, how have my procedures changed? Someone can't just walk to the next office and drop reports on someone's desk and say, review these and come back to me in 10 minutes. They can still do that, but they're not going to walk to their office. They're going to scan them in and email them. And how do you know that, you know, who knows what can change and things of that nature. So these are the type of things that we would like people to think about. So 2 questions came in, or actually a few questions came in on the PPP loans. I just want to hit them real quick. Someone asked how much audit effort will be made to audit the forgiveness for those BDs that anticipate 100% forgiveness. Will auditors be asking for support? Yes. So if a broker dealer is going to follow the grant model, the IAS 20 model, and not show it as debt, that's going to substantially increase the audit effort for this period. And we're going to want to see the calculations, the support, the forgiveness application, and understand management's rationale for believing they meet that threshold for forgiveness. Next question, also on the PPPs, what accounting standards specifically would outline the disclosures for PPP loans? Well, I think you'd follow the debt provisions under ASC 740 that talks about debt. I think you'd follow pretty much along the same lines as what you would do with any other outstanding bank obligations that you would have, and of course describing the potential for forgiveness and how it arose and things of that nature. And someone wants to know why Mike is wearing a bow tie. Because he looks good, doesn't he? All right, so let's move on. FinOps. This is another, basically another question for COVID. And we just, again, we want people to think about this stuff because these are the type of things that could slow up or delay the audit. And we all know that we've got an awful lot of work to do in a very short period of time. So the more you can think about this stuff in advance and maybe, you know, prepare a brief little memo or something, that would be very, very helpful. So I want to throw out to the FinOps, have you considered impairment of fixed assets or intangibles such as goodwill as a result of COVID? Now, specifically, I think the pandemic generally is considered to be a triggering event for purposes of a goodwill impairment test. I don't know how prevalent it is in our broker-dealer business. I know I don't have any broker-dealers, but just want to get the thoughts of the FinOps. So Janice, let's start with you on this one.
I really don't believe, as you said, I don't believe it applies to any of my clients at the current time. So I haven't given it that much thought. But
Mike, any thoughts before I do my narrative?
Yeah, I have 2 thoughts. One, anybody that thought they were being smart by pushing down, by using push down accounting is now going to pay for it. And, you know, with regard to the fixed assets, that's very interesting because I think that's more critical than the goodwill. I mean, goodwill, the evaluation should be ongoing. But, you know, there are a lot of people that have basically left their offices. And if they have no intent on coming back, you know, you really should start sifting through your fixed assets and, you know, moving them off the books at this time if it's applicable.
Okay. A lot of firms might have gone out and bought more fixed assets so people could work from home and take monitors home and things of that nature. But, you know, the point here is to think about this and to document why or why not there's not an impairment. So if your broker-dealer client is still going to the office every day and their business hasn't really suffered, then you're probably right, Janice. You don't have much of anything to put in a memo other than to document that, hey, you know, it's business as usual for us. But if your business is down, you're not in your office, you know, you're struggling to survive, these are some of the things that would maybe trigger a much more in-depth and robust consideration of whether or not you've got some impairment. And look, we're not talking about, oh, should I impair this desk or, you know, this computer screen? I think we're more concerned about leasehold improvements and leased facilities and things of that nature. So just something, again, that we want people to think about. It may not be something that's a huge issue for many clients, but let's think about it and not think about it on February 23rd. Another question for the FinOps. Have any of your clients received any lease concessions from their landlords? Jay, can you share some thoughts on that?
So no lease concessions. We had, I know one client in particular who went back to the landlord and was given the option of basically deferring their rent for, I believe it was 90 days. So we just basically accrued for it, you know, booked effectively deferred rent or booked the liability for the period they used it. They're going to pay it obviously, you know, at some later point in time, you know, 30, 60, 90 days later. But I'm not aware of any clients who actually were successful in going back to the landlord and actually, you know, either not having to pay rent or getting a specific discount on their rent.
Okay, Janice, any thoughts on that one?
No, I haven't heard of anything. Concession.
No clients? Mike?
No.
Any clients with any modifications? Nothing?
I think for the landlords, it's a slippery slope because once they offer it to, you know, landlord A, they're going to have, you know, 300 other, you know, or sorry, the tenant A, they're going to have 300 other tenants coming in and asking for the same thing. So I think that my experience has been that the landlords are not, you know, overly willing to make those concessions at this point in time.
Okay. We'll pivot now to the auditors for a couple of questions. Laura, we'll start with you on this one. What documentation are you going to be looking for from your clients relative to asset impairment testing or any impairment testing?
Well, I would say that, you know, as all the FinOps have said, I don't have that many clients that are either have, you know, had a significant decline in operations or that had significant goodwill or intangibles on the books, or even honestly significant fixed assets. But should that be the case, and they did have a triggering event as a result of the pandemic, then I would be looking for probably projected cash flows, you know, starting from that period when the decline in revenue happened, because the impairment happens at the date of the triggering event, not, you know, we can't use our hindsight and look at it at the end of the year and say like, oh, okay, they recovered. We have to look at that point in time where the triggering event occurred. So I would be looking for that, mostly cash flow forecasts from that period, you know, and other documentation regarding, you know, what has happened with their operations.
Adam, you want to add to that? Anything to add to that?
I would say the only thing, you know, if the broker-dealer does have a significant proprietary security balance, you know, consideration of those level 1, level 2 securities, and whether those fair value measurements are consistent with, you know, the active market and orderly transaction terms under ASC 20, and if the management of that broker-dealer would need to do anything additional there.
Yeah, I was surprised, actually. I mean, you know, we all witnessed the market in a tailspin for, I don't know, a week and a half, 2 weeks, maybe 3 weeks, and then kind of stabilized and went right back up. So I mean, maybe there might be a focus report that might have been filed where that might be an issue, Adam, but I would think largely once the Fed stepped in and started backing all these, you know, other assets and debt obligations that were out there, I think it kind of stabilized the market. So,
yeah.
Warren, anything to add to that? I think they covered it pretty well.
Yeah, I would just pretty much add that if, you know, depending on the type of broker that you have and the business that you're in and what your operations are, you probably pretty much have a good idea of whether or not an evaluation needs to be done just based on how the broker is doing. And that would be step one in the evaluation. Because even if you think that nothing happened, as Laura has said before, you know, providing nothing is not an option if you have any assets on the books. But, you know, to make it, in my opinion, to go away would just be, these are our operations, this is our company. You know, we're not really impacted by this. You know, that's how it start the process.
All right. Provide thoughts on lease concessions from, you know, from an auditor's perspective. If any clients happen to be successful in negotiating with their landlords.
It's an interesting question because it's very similar to what the FINOPs are saying, that, you know, I've spoken to all my clients and I don't know anyone who actually has received a lease concession to begin with. But I guess the approach is, okay, so what's a lease concession, right? It's either no payment or less payment that's agreed to by the landlord that's not in the contract, right? So what is the SEC saying in this regards? Well, they're saying actually, well, this applies to in the general course of business in accordance with the agreement. This wasn't meant to handle a pandemic or something completely extraordinary. So they said, well, with that in mind, you know, they've offered some guidance that you can actually decide. You can choose what you'd like to do. You can choose whether or not you want the concession to be from, you know, enforceable rights and obligations that are part of the contract, regardless of whether it's actually explicitly in the contract. So it won't be considered a modification, or you can go with the standard lease modification treatment. Now, considering the fact that, you know, you have that option, if it's not in the agreement, you know, there's definitely some judgment involved in terms of how to go about doing that in terms of making that determination. But I think it's important to note that, let's say you do go that route, it's still important to know that the change in the rights to the lessor should not be, it should be relatively, nothing's really changing. Yeah, you're deferring payments like Jay mentioned, but the actual amount that's going to be paid and the general terms of the agreement shouldn't change that much. There shouldn't be so much in terms of modification. But if anyone's seen it, please let me know. I'd be curious to know who gave a lease concession.
And I think the important thing is that if you did receive some sort of concession from your landlord, that you let your FinOps know, and certainly you let your auditors know, so you can get ahead of it and determine if there's any modifications that need to be made to your 842 disclosures and right of use asset and corresponding liability, and as the case may be. Adam, anything to add to that? Or
yeah, the only other thing I would add is, you know, with respect to disclosure requirements, if lease concession related to the pandemic, you know, kind of was taken advantage of, you know, the FASB has indicated that you should be providing disclosures about any material concessions received, and also the accounting effects of that actual, of that lease concession. So I think that would really mean quantifying what that amount was and disclosing that in the notes of the financial statements, you know, if that were to occur.
I want to point out one wild and crazy thing with regard to the regulatory aspect of it. Lease concession may be reason for someone to amend their U4 as management of a broker-dealer coming to a settlement on a debt. So keep that in the back of your minds, folks.
Interesting. Even if it just terms it out. So in other words, you didn't pay rent for 3 months, but that rent is just going to be paid over the remaining.
No, that's not the
5
case.
years?
I'm talking about, you know, your typical concession where it's, you know, rent's been waived.
Okay.
If there are any of those things, there's, you know, the U4 speaks of compromise of debt, and you know, if it's been just reorganized, I don't think that that's compromise. But if you have forgiveness and things like that, I think that definitely is just something to consider.
Our next question is really something that has been out there, has been around for quite a few years. Some organizations put more emphasis on this than others. Also, it's a facts and circumstances type of test or analysis, but as we all know, there is a requirement to document an entity's ability to continue as a going concern for at least 12 months from the report release date, from the day of the auditor's report. So I'm going to ask everyone to share your thoughts and recommendations on this topic. Obviously, we've got a lot of things that add more fuel to the fire of the auditors in terms of what we're going to want to see addressed. We've got a pandemic, we had a presidential election, we've got who knows, what might happen in the next month and a half before the year end. You've got PPP loans, what's happening with your business, work from home, et cetera, et cetera. So Mike, what are you doing in terms of getting ahead of the going concern analysis memorandum for your clients at this point?
I think those where it's any concern, we're dealing with it now, but for the most part, it doesn't really affect my clients. It's just all part and parcel to the big picture. The presidential election may be more of an issue than the PPP. I'm kidding.
Warren, thoughts on that?
Yeah, I'd say that with regards to going concern, we're going to go through the same analysis and ask the same type of questions that we've asked before, and the burdens on management to really support their position of why they believe they're okay. So we will ask those questions about, well, we'll look at net capital and equity and cash flow and whatnot, and we'll see what's the impact and how it relates, how COVID has impacted this. And same idea, we'll just need supportable evidence. We need proof that they're able to continue as a going concern for you.
And depending on the broker dealer, the evidence that we would look to see could be different, right? So if it's a commission broker or a broker dealer that's receiving asset management fees or advisory, fees for advised assets, we can see monthly what those trends are. If it's an investment banking broker dealer, we may ask to see contracts that are being worked on, the pipeline, the deal pipeline. So that, these are some of the things to consider as you start gathering information to address that. Jay, any thoughts on that?
Yeah, the biggest thing for me is I just think that the going concern assessment should be based on that specific entity. So if you have an entity that has, it's a $5,000 broker dealer that has $20,000 in net capital, I think the going concern analysis is absolutely fair. But for me, a going concern analysis should not be based on global. Like, I don't think that, there being 300 million coronavirus cases in the US should be a going concern disclosure. I don't think, the election should be a going concern disclosure. I don't think, an earthquake should be a going concern disclosure. It should be focused on things that are relevant to that specific business and their ability to operate, not assuming that the world is going to implode in the next 12 months.
I would tend to agree with you, Jay, but I'd also think it's important to look at, let's say, so if you're saying you're a 5,000 broker dealer and you have $1 million of net capital, it would still want to go through the evaluation depending to see, okay, well, what's the burn rate that you have on cash and what are your expenses? You'd still go through the analysis. It just wouldn't be as
robust.
Right, as robust, as concerned.
I completely agree, but that going concern analysis that you're doing in that scenario, I think the analysis that you should do for 2020 should be the same analysis that you did for 2019. It shouldn't change because of a pandemic, in my opinion.
Adam, you want to chime in on that a little bit?
So I will say that to Oren's point, I do think that, the analysis would be required, regardless of whether, you have a small minimum net capital threshold. And yeah, I would expect that COVID-19 considerations, layoffs, restructuring, things like that, would be considered in that analysis. But to Jay's point, I think it would depend on the facts and circumstances, the revenue streams of that particular broker dealer, as to the robustness of that analysis for management.
The way that I always look at the audit report, going concern or not, is that the goal of the audit report is to be able to provide a tool for an investor or some sort of external party to assess the financial stability of that legal entity. And things, things that take place in the world, like elections and earthquakes and pandemics, I think for me are public knowledge. They're things that any external user that should know, irrespective of reading that report. So that for me is where I delineate it. It's something that's specific to that legal entity that is necessary for the reader to be able to see in order to understand that business. That for me is fundamentally different than being able to turn on turn on CNN or Fox News and stay up to date in things that are inherently public knowledge.
Janice, anything to add?
No, I agree with what everyone's saying. And I feel like if you go back to one of your earlier questions when you asked about any issues, operational issues and so on with our broker dealers, we all sort of agreed that no, that hasn't really been a problem. So I feel like it's not as much of an issue as maybe we're making it out to be, as Jay mentioned and everyone else. The external issues doesn't seem to really affected the broker dealers that much this year. So I think management will make their assessment like normal. I think it's going to be pretty much like every year.
I hope so. I hope most of my clients are thinking about what they need to document to provide to the auditors. I do agree. I think the brokerage industry came through to this point quite well, unlike many other industries. Let me see, I think we have a question. Somebody asked, does the going concern standard specifically state to consider market and world events? I believe the answer to that is yes. You're not operating your business in a vacuum. What happens around the world could have implications to your business. I think it's less prevalent in the financial service area, especially in the broker-dealer area, as opposed to manufacturers or service providers to certain industries. But nevertheless, if you have a major customer in an area of the country that is, burning up or flooded or who knows what, it's going to affect your business, and it's got to be something to be addressed in a going concern analysis. We're heading into the home stretch. Adam, I know you've been waiting patiently to talk about this. So with everything that has transpired in 2020, COVID, I already mentioned the election, weekly hurricanes, civil unrest, most folks have lost sight of the fact that the FASB's still out there and there's still accounting pronouncements that are effective, for the first time this year. And probably one of the biggest, stress points that we as auditors have had over the last 3 years is 606, 842, and now 326, CECL. And that was effective for broker dealers effectively on 1/1. So can you highlight for us, some of the main differences between what I'll call legacy GAAP and the new CECL model?
Yeah, no, thanks so much, John. I've been waiting for this. So yeah, legacy GAAP versus the CECL model. So first, with respect to the recognition threshold, previous GAAP was a loss was incurred at the balance sheet date. Now, though, under the CECL model, lifetime credit losses have to be considered when, even if that risk is remote. So even if there's virtually no risk of loss. So in most cases, you will have to recognize a lifetime credit loss. The unit of measurement under legacy GAAP. So previously pooling was permitted, but was never a strict requirement. But now under CECL, pooling will be required when assets share certain risk characteristics. Other, kind of high level changes, economic conditions. So previously you would just consider current economic conditions, but now you'd have to consider current as well as your expectations for those future economic conditions as part of that loss. And then now you also need to consider the actual contractual term of that receivable, whereas under legacy GAAP, it wasn't part of that calculation. So I would say that those are the probably high level changes between the two.
So when you say the lifetime loss as opposed to the balance sheet loss, the balance sheet date loss, so that means on the day that you have that receivable or have that obligation from another party to pay you, it's at that point that you have to determine what that loss may be.
Yeah, you'd have to go forward, to the lifetime of that receivable in order to determine that loss, rather than at that point in time under legacy GAAP. So what's the effect there? So, really you're going to recognize those credit losses earlier, record credit losses on assets, that previously may not have been recorded under legacy GAAP.
So I know this is an area that there seems to be a little bit of a misunderstanding potentially, especially on the broker-dealer, in the broker-dealer area. I mean, I've seen some financial statements for some public broker-dealers that have, $5 billion of assets that would be subject to the credit impairment losses, and they book a $10,000 opening provision for the credit impairment loss. I think our own internal presentations have indicated that the CECL loss cannot be zero, but I think really to say it can't be zero is not appropriate, because I think you really need to look at who owes you the money, where is it coming from? So can you share some thoughts on that?
Well, first, obviously they agreed with you because it wasn't zero. They put down 10,000.
But it might as well have been zero. It's like 0.0001%.
Yeah, it's a fair question. I will say that the FASB in their implementation guidance, so subsection 55, does give the example of when a zero loss would be appropriate, and that is a U.S. Treasury security. So that's a very, very high hurdle. There's no history of credit losses, high credit ratings, explicitly guaranteed. It's the risk-free rate. So that's what's been put out there in terms of what would be a receivable that would have zero expected credit loss. But I will say that ASC 105 does always allow for materiality when management is assessing their impairments. But that being said, there is some expectation that they would have that process in place in order to conclude in this case, it was, I think, $10,000 in your example. Maybe other receivables would be zero because it wouldn't be material to that entity. But yeah, the standard does say that, in order to have a zero expected credit loss, it's pretty much at the U.S. Treasury level of risk-free.
So would a broker-dealer have to assess its receivable from its clearing broker under CECL?
Yeah, I think that would be a receivable that would be in scope of the CECL standard. Other common ones in scope: securities lending, any trade receivables. Things that aren't in scope though. The right of use asset under 842, fair valued securities, receivables from entities under common control. Those would be outside of the scope of CECL.
What about cash in the bank? What if the bank goes bust?
Would that be considered a financial asset? I think there is some debate there, but I believe the answer is yes there.
So the long and short of this discussion then is everyone is basically going to be required to come up with some memo saying why they believe their CECL loss is as close to zero as possible, but maybe not zero, something that would be immaterial that would need to be booked.
So you're telling me if I got cash in bank and liabilities, I have a CECL loss of greater than zero? Good luck with that.
I mean, it's so challenging because even if you look at the regulations, I mean, FINRA doesn't require broker dealers to take a haircut on cash, right? So FINRA by rule is saying this is an allowable asset at 100%, and then effectively this new standard is saying that that's not true anymore, and now it has to be, you know, devalued in some capacity. And I think to piggyback that is, you know, if theoretically we determine that there is a, you know, an adjustment, you know, there's so much discretion as to what that percentage should be. Let's put cash to the side, right? If we have a receivable from for an investment banking deal, you know, if the answer isn't 0 and the answer isn't 100%, how do we determine if it's 5%, 25%, 50%, 90%? There's so much subjectivity in that assessment. You know, I don't know. I feel like no matter what answer a firm chooses, the auditor can theoretically come back and say, we don't agree with your assessment. You know, it should be something else.
Well, Jay, I think, you know, I think to your point, you would look at his history. Has the broker dealer historically had losses from their investment banking transactions? I mean, probably not, because they get paid at closing. But in some cases, some broker dealers will get, you know, 50% up front and 50% over a period of time. I mean, have they ever suffered a loss? Who is that receivable from? Is it, you know, is it from a private equity fund that's got, you know, millions or billions of dollars under management, or is it from, you know, a distressed company that just, you know, acquired another business? So that's the analysis, I believe, Adam, right, that needs to be done. Look, you can conclude that, yeah, we're probably going to lose $1,000 on that receivable. Okay, it's immaterial. We're not going to book anything.
Mm-hmm. Yeah. And it also has no, obviously not a GAAP consideration, but it also has no net capital impact, because that asset by default is going to be, you know, at least the receivable is going to be not allowable anyway.
So Adam, I don't know if you see the couple of questions came in. I don't know if there's any that you want to address, but what do you mean by pooling? Is somebody asking that question? Do we no longer look at ISI items?
Yeah, so the new pooling standard under CECL would require management to group specific financial assets together based off of certain risk characteristics. So once again, in their implementation guidance, they do give certain risk characteristics, but you know, credit ratings, historical loss patterns, future expected, future forecast periods, vintage, so things of that nature. But once again, that list that they do provide in the actual implementation guidance isn't all inclusive. So, you know, there is some judgment for management in grouping those assets when assessing the impairment. And I guess I can talk a little bit about, you know, what may be the most common way to assess impairment for broker dealers. Mm-hmm. So, you know, I think of the methods that are listed, you know, discounted cash flow, probability of default. I think, you know, the most common method would be actual aging schedules. So, you know, what that really entails is impairment would be calculated based off of how long that receivable has been outstanding. So you'd have a schedule, you know, 30 days, 30 to 60 days, 60 to 90 days. And, you know, you'd first pool the receivables with similar risk characteristics. You then consider what were those historical loss rates? Is there any need to adjust those loss rates for, you know, current economic conditions, in this like COVID-19 environment, as well as reasonable and supportable forecasts. And then, you know, lastly, you'd apply that actual loss rate based off that pooled balance to the amortized cost in order to determine the actual CECL allowance.
And then there's a couple of other questions. Are you seeing CECL impact on broker dealers and what accounts? Some of these reserves would be so small that they would be immaterial. Is this a consideration from an audit perspective? So yes, it is a consideration from an audit perspective. Yes, they may be very small. The accounts typically, I think that from my broker dealer clients, the greatest exposure is probably in the stock loan accounts. If they're, you know, if they're doing any lending activity, that would be where the most likely losses would be. So yes, it's limited in terms of its impact, but it still requires some analysis or some thought on the part of the company to basically conclude that it's immaterial. Hey, yeah, we have these receivables, we have these financial assets, and here's why we think it's immaterial, that the loss will be less than some number. And another question came in, wouldn't historical losses be zero on cash? So no CECL loss. I mean, yeah, I mean, I would like to think that that's the case, but if it can't be zero, then, you know, maybe it's got to be $1.50 or $1.75, something like that. I don't know. But look, this is all new. The whole point of this is to get ahead of it, to think about it now, to think about, you know, what do I need to put on a piece of paper so that when my auditor asks for it, you know, we're ready. We're ready for it. We thought about it. Okay, let's move on. All right, I'm going to skip over the next one. Okay, so this is for everyone. Obviously, subsequent events has long been a required disclosure. What advice do you have for your clients regarding this requirement this year? Janice, you want to kick us off?
I mean, I think the only thing I can think of this year that's different in terms of subsequent events would be what I mentioned earlier. If a firm has applied for forgiveness, but as of year ends, they have not received that formal notification, perhaps they would have a subsequent event note about that. Or maybe the forgiveness comes through, let's say in February. I would imagine that would have to be disclosed.
Okay. Jay?
Yeah, I agree. I think the assessment generally should be, you know, an assessment of the 60 days after the fiscal year end. And if something happens in that 60-day period, you know, we should consider the materiality and whether or not it's disclosable. I do agree with Janice. I think that if you have theoretically, you know, for me, the application being submitted is less impactful. I think if the firm submits it, you know, on or about now in 2020 and gets approval between, let's call it January 1st and March 1st, you know, in the subsequent event period, I think it's a fair, you know, assessment that would be a disclosable event.
Okay. So we're now down to about 4 minutes, and I know Janice was the lefty summoned from the bullpen, and she's got a commitment at 6 o'clock. So I want to jump into basically one of the last questions that we had here. And Mike, I'm going to start with you because I think you had some very interesting things that you wanted to talk about here. So can you share any recent FINRA exam findings that are kind of not typically highlighted, might be kind of like one-off type scenarios and something that we ought to be thinking about?
I do. FINRA has a bug up their tuchus, that's a technical term, about CDs. What they're doing is looking at firms that have certificates of deposits with banks, and to the extent that there's no liquidation clause in the CD, they're basically coming back and saying it's not allowable. So we've gone through this more particularly in 15A6 firms because they're sitting with large piles of cash and they don't take positions. So they're just there substantiating, you know, their fail business. So, you know, FINRA has come in and basically said they're not allowable. Meanwhile, in one case, I know they liquidated it immediately. So that sort of put it to rest. In another case, they got letters from the bank, neither of which were FINRA happy about with regards to it being allowable on a particular date prior to those events. So it's problematic. And the other thing that people may forget, that to the extent that you have certificates of deposits, commercial paper, things like that, not, you know, M1 money supply stuff, the amounts that exceed 30% of your tenant net capital are already not allowable. So be very careful when you touch CDs, not only from a net capital standpoint, but also with FINRA coming in and doing exams and knocking out the allowability.
Okay. Janice or Jay, anything to add on recent recent exams?
Yeah, I mean, I would say just, I can't, I've said this before, I can't re-emphasize it enough. Personal expenses on the books of broker-dealers, they are absolutely crazy. Personally, I think it's an IRS test. It's not a, a regulatory test. It doesn't impact, integrity of markets. It doesn't impact customer protection, but they are super keen on this. They keep focusing on it. I'll give you a quick anecdotal 20-second story. I spent an hour and a half on the phone with FINRA end of last week, disputing a $51 nail polish charge on the books of a broker-dealer. The firm bought the nail polish as effectively an adhesive to be able to close envelopes to, as a precautionary measure for COVID in March. And the examiner just has, just has it out for them and is trying to make an assertion that the owner of the firm bought it for his wife. So $51 is completely meaningless from this, $6-7 million a year in gross revenues. But the amount of time and aggravation to deal with it is beyond painful. So if you can avoid it, please avoid it at all costs.
I would have just avoided responding to FINRA's discussion on the matter and told them to write it up.
Mm-hmm.
So there was a couple of other topics that we wanted to cover. I'll just mention them quickly. I know we are at 6 o'clock, but we wanted to talk a little bit about some new provisions in ASC 740, the income taxes. There appears to be some early adoption, early adoption of the changes to the standard that would allow single member LLC disregarded broker dealers the option of not having to book or reflect the tax provision on a standalone financial statement. That's one thing. And another thing, just wanted to point out, keep everybody in the loop. PCAOB was active this year too. There's a new standard for auditing accounting estimates. So that's another thing to keep in mind. If you have any significant estimates in your financials, we are going to obviously be asking some more questions on that. So with that, I want to certainly thank my panelists. Many of you folks took time out of your very busy schedules and or substituted at the last minute. So thank you all. And I want to thank everyone for attending, and please stay safe in these crazy times. Try to enjoy Thanksgiving dinner through your mask, and we'll see you all on the beginning of 2021, hopefully somewhere in the near future. So thank you.
Thank you, John.
Bye-bye. Thank you.
Thank you.